Well, good morning, everyone. Thomas Montgomery here. We get together with our distribution partners and our clients most weekday mornings at 8 o'clock Central via Zoom, just like now, to talk about strategies, tips, share success stories, and support each of you. Normally, I try to keep our agenda to one page just because it's more concise. Today's is actually 2 pages, and I'm at the bottom of page 2, but we'll quickly bounce up to the top of page 1. When it comes to business funding, only a skeptic would suggest that lenders are not lending money. So we have several examples here of some recent closings that, again, it's at the bottom of our presentation, but I want to start with this, and then frankly, I'll come back to this at the end. So there's different amounts, and there's different industries, different types of funding that takes place. Sometimes it's a business acquisition, sometimes it's ground up construction, sometimes it's equipment financing, sometimes it's a working capital loan. It varies. But regardless of the details of this sampling, what would you and I agree is true in every case? Why did these clients, why did these businesses get funding? Is it because they really wanted money? Is it because they really needed money? Or was it because they were qualified? Obviously, it's because they were qualified. So let's move up to the top of our agenda. On today, October 19th, 2023, we're going to go through 3 categories of loan or funding program. So there's other non-traditional, but these are the 3 traditional types of business funding. And I think it's important that you're clear with this stratification, this categorization, because when you and I are helping clients become qualified for funding, because we know if we're qualified, we can access a lot of money, crazy amounts of money. But we need to build a package. We need to understand how much capital the client needs. We need to understand what they're going to use it for. We call that use of funds. If you think back to our prior trainings, we talked about in phase 3 of the process. With phase 3, we're putting together the documentation. There's 6 elements. We're looking for the business's last 3 business bank statements. And maybe they haven't been open that long, so those may not exist. We're looking for the balance sheet, which even if it's a brand new business, we should be creating a balance sheet for our clients. We talk about that quite a bit. Income statement. Now, granted, if it's a brand new business, there wouldn't be any revenue or expenses yet, possibly, but that's one of the 6. And then the business plan. There's different types of business plans that can have different degrees of detailed content. But at the minimum, as many of us have discussed, we need to at least know how much funding does the client want and what are they going to use it for. So again, let's go back and look at the outcomes. So when this company wanted almost $20 million, could they just say, oh, it's just working capital, I just need some money? No. It had to be specific. What is it that you're wanting the money for? Because that affects where we go for funding and what the qualifications are. If we're looking to start a new business, that's a very different type of a capital raise. If we're looking to acquire an existing business, and we're working with a number of you on a number of these right now. So what's my point? My point is I need you to understand that there's 3 primary categories of traditional business funding. Now, again, there's many other alternatives, but these are the big 3, if you will. So let's start. I guess we should read this paragraph here. So as a branch office, which many of you are, and if you're not, we'd encourage you to become one, you're positioned to earn an adult income by helping others. The business startup program is likely a very important tool in your toolbox. Why is that? Because it provides a turnkey resource to help anyone create a credible business that's positioned for fast funding. And highlighted in red here, having a credible business is key to getting funding. I guess that could be better written to say having a credible business is key to getting business funding. Because if someone just wants personal loans, you don't need a business plan and you don't need a commercial address and all of that, do you? But an individual doesn't have near the borrowing capacity that a business has. So at the core of what you and I will be doing with each client or each prospect is determining, is their business credible? And if not, we need to fix that. Otherwise, we're not on track to go get large amounts of business funding. Now, you can't throw out these excuses. Well, it's a brand new business. They can't be credible. That's inaccurate. That's the wrong type of thinking. That's misinformation. That's going to harm your client and it's going to harm your income. Startup businesses can be credible on paper, and that's exactly what you and I do with the business startup program. Is we're providing them a credible address, which is at the core of credibility of a business. We're getting them formed with Secretary of State so they're compliant. Of course, getting the EIN, the bank account. We're adding trade lines under the EIN so they look credible from a perspective of a Dun & Bradstreet Paydex score, an Experian Intellis score. And to the extent that they need help, then we're able to build out their business plan and their financial projections. That's what, in short, that's what a credible business is. And I just need to make sure that we're all on the same page, that's the key, right? That's what allows the funding to happen, is that we have credible businesses. But the wonderful thing is any business can be credible. You and I can help them do so. With that being said, let's go back to the point of 3 categories, because for every client that you have, that you and I, that we're working on, we need to know what type of capital raise is it? And it could be a combination, right? It doesn't have to be exclusively one or the other. So let's first look at business loans and lines of credit. And this is probably the biggest bucket that you often would run into. That's when these funds can be used for business purposes. It could be to buy real estate, to buy or start a business, for working capital, to refinance debt. We're doing a lot with people that have merchant cash advances that are looking to get out of that. That's a great target market right there, is getting clients that have MCAs that want to get out of them, because those are very expensive. So this is a very broad category. In contrast, we're going to talk in a minute about equipment financing, and then we'll talk about real estate financing. So in general, if it's not real estate and not equipment, then it is our general category. We have many different types of lenders that we work with, and we're not a lender, right? You know that. We're not the bank, and so you're not a bank rep, right? So we're technical advisors. We're helping clients become credible for funding and then helping facilitate them getting that funding, which is immensely important. It's needed because there are lenders that are out loaning money, right? The money's flowing. There's not a problem with getting funding if we have a credible business and a credible package. That's typically what's missing. That's the problem that you and I solve. So the point is, there are different lenders that loan different amounts of money, that have different appetites for different types of deals. But just to express, in this category, this could be a very small amount, or it could be a quite significant amount. The truth is, it doesn't have to have a hard cap at 25 million. The truth is, normally once we get above 5 million, it becomes much, much more difficult, but it can be a bigger deal. This is where we're normally looking at monthly payments. So these aren't these very expensive daily or even weekly pay. So this is traditional. We're talking about traditional business loans and lines of credit. Now, in some cases, it's short term because that's what the client needs. In many cases, it's long term. Long term, usually for this category, would be a 10-year repayment, 120 months. And then there's also lines of credit. A line of credit, and that's not meaning a fancy way of saying a credit card. I'm not spinning that. But a line of credit just means that there's an approval from the lender. The client can pull from it when they need and then pay it down. Lines of credit are not intended to be used like a long-term loan instrument. I remember I was sitting down with a vice president of a bank when I worked at the SBA, and his name's Mark, first name's Mark. And he talked about how he worked at that time with Compass Bank, and he talked about how the bank will review users of lines of credit. And if they're using it as a permanent instrument, they may close it because that's not the intent. It's meant to be there when it's needed, but not a permanent use. That's where we go with a traditional loan. We see some great flexibility in underwriting, unrestricted working capital. Again, the easiest way to categorize that is it's everything other than equipment financing or real estate. So we'll have to maybe sometimes describe what we want the money for, but once it's placed into the client's hands, usually via wire, then there's usually no constraints on it. So the client could use it for whatever they want. We have a number of lenders with streamlined underwriting so we can get deals done very quickly. We were doing SBA, some, not all, but we were able to do some SBA loans in 24 hours. And that was outstanding and pretty much unheard of. When the changes occurred with the SBA lending protocols as of August 1st, we actually have seen that change, and now it's within a couple of days. So if you see any older trainings where we said SBA loans in 24 hours, that was true then. Now it's more like 72 hours. No prepayment penalties. What's nice about this, and I know some of you have asked, well, let's say that we go help a client get a working capital loan now, but they don't qualify for all that they ultimately want. So let's say they get $85,000 now, but they really want a total of $150,000. Can we go back? Yes, typically after 90 days, we can go back and do another working capital loan, even with the same lender. And yes, absolutely, we can get startup financing. What does that mean? So a business that's not been in operation, that doesn't have clients, that doesn't have revenue yet, is there startup financing available? Absolutely. So this is the first of the three categories. Now, there's no reason for you to start asking me, well, what's the interest rate going to be? I don't know, right? We're going to have to get the client in. We're going to have to put their package together, and the lender is going to decide that. Right now, we're seeing typically, if I had to just give you an average, I would say 3%. 3% above prime is pretty common. But you and I never want to be in the role of quoting interest rates or guaranteeing interest rates, because you and I are not the bank, right? So we need to know our role. We're here as technical advisors, help clients build their credibility, build their package. We're not the lenders. We don't loan any money. I had someone ask me once, well, how much money have you loaned? Zero. We're not set up as a bank. You have to meet all kinds of regulatory requirements to be a bank. We're not a bank. We don't pretend to be a bank. I presume you're not a bank. But the world doesn't need another bank. There's plenty of money out there. There's not a problem with money. The problem is having clients that are credible. That's what you and I do. All right, so that's the first category. Everybody pretty much have their arms around that. So when you're working with one of your clients and I say, hey, where's the uses of funds? Often that's part of the business plan, but it could be just a separate entry put in the Dropbox. You don't have to mention all these bullets, but we need to know, is this the category we're looking for? Because it's treated differently than the next category, for example. So let's go on to it so it makes more sense. So a separate and distinct category is equipment financing. So can we help clients get multiple categories of funding? Absolutely. But the uses of funds needs to identify how much is needed for each category. Plus, if it's equipment financing, we need to identify, as crazy as this sounds, and that was sarcastic, sorry, what equipment they want to buy. So I've had some of you come to me and say, okay, well, the client wants $100,000 of equipment financing. Go get it. well, what equipment is it that they want? You don't get equipment financing generically. This is kind of the general bucket here. Here, this is not general. We have to identify, do we want a forklift, a dump truck, a copy machine, a business sedan? What is it that we're buying, right? Now, the neat thing about collateral, and we've had lots of trainings on collateral, equipment financing, and frankly, also real estate financing serves as its own collateral, right? Because they'll put a lien against the real estate. They'll put a lien against the equipment. So in the uses of funds, we need to break down how much money do they need in the first category, if any, how much in the second category, if any, and then we have to list what that equipment is. A lot of times we need to go get literally what would be called the purchase order or the invoice. We need to get the specifics, because in many cases for equipment financing, this money goes directly to the seller of the equipment. Here, the money is typically being wired into the client's bank account. Now, avoid the temptation. I've seen a few of you do this because some of you are clever. So some of you will just say, well, it sounds like more work to do equipment financing because I got to provide details. Let's just scratch that and let's just go get lots and lots of business loans and lines of credit. Well, that may or may not work, because now we have to have the credibility for large amounts of loans and lines of credit, such as the collateral, right? So can you and I provide as much collateral as a client needs? Sure. But we may not be doing the client a service by miscategorizing the funding, because if it's really in part or all for equipment financing, we should identify that. Now, equipment financing is pretty easy to get, so that's good news. It can be little, it can be a lot. Typically, they'll try to match the repayment terms with what's called in accounting the useful life of the asset, but often 10-year terms. What's great is it's flexible. It can be from a dealer or from a private party, which kind of links into it could be new or used equipment. In many cases, can't guarantee these terms, right? But in many cases, it can be 0% down. And yes, startups can qualify. So I know I went to a dealership and I bought a company vehicle in my company name with no money down under my business credit. And I recommend that each of you do that too, whether you're a client going through the process or just a distribution partner. Pretty much all of us in our society needs transportation. Get the transportation in the business's name, because then it's fully tax deductible. You're building your business credit and you're keeping it off your personal credit. So we've covered business loans and lines of credit, kind of the general. And now we've quickly just talked through equipment financing, with the understanding that if we're helping a client get equipment financing, we're going to need to identify what is that equipment, because typically the lender is going to pay the seller directly versus here, as I mentioned a moment ago, wiring the money into the client's account. So we all good with the difference between those two categories? Then the third and final category, which takes us back down to the bottom here, let's make this just a bit smaller, would be real estate financing. Pretty clear, right? We're buying real estate. So this could be used to purchase real estate, to refinance real estate, for the development of construction, like we talked about with the apartment complex, or even bridge loans. Fully amortizing loans, no prepayment penalty. They do offer some innovative models, which include an interest-only payment arrangement, which obviously lowers the monthly payment, expedited closing, flexible underwriting, and it can work for both investor and owner-occupied commercial property. All right, so Adam's asking this question, which is a good one, on real estate financing. Let's say that you want a home to live in. Can you use this to buy your home? Well, we got to step back and say it depends. We're not mortgage loan officers, and we don't facilitate personal residences. But Could Adam buy that home using real estate financing through his business with the intent for it to be an investment property, with the intent that he's going to lease it out either short term, like through Airbnb, or lease it out long term? Now, if that's the intent and he closes on the property and then his family stays in it, yeah, that could work. But we're not mortgage loan officers, so we don't do private residential mortgages. But you can find many reasons why you would want to purchase real estate in a business's name, fully tax deductible and other benefits. And even if you resided in it, if it were positioned as I described, it would work. Does that make sense? We've done a lot with purchasing condos, I guess mainly condos, oftentimes in high-rise buildings, Miami or what have you, where people are wanting to buy condos and then furnish them and then use them for short-term rentals like Airbnb, or what's the other one, Burmo or whatever it is. All right, and so then we started with the conclusion. Money is out there. Getting money to start or grow a business is completely doable, and our model can deliver. We need you to be good at what you do, which is to create awareness. And as you create awareness, in many cases, what you're going to find is that the client lacks a credible business to pursue funding. You and I have a very simple solution for that now, don't we? The Business Startup Program. So you can get them enrolled in the Business Startup Program. Going back to the bottom, that puts a fast $1,250 in your pocket. I know that's not a big deal. I know a lot of you make a lot of money, but there's frankly no reason we couldn't help at least one client a day. So if up front you're putting $1,250 a day net profit into your pocket, then certainly if you wanted to, you can add a performance fee to the Business Startup Program. We don't by default, but you can add that into your agreement if you want. And or you might find that the client would also benefit from being in credit and funding. So with that being said, let me open it up for your questions, comments, concerns. My goal today was to make sure that each of you understood the difference between these three categories of funding. Now, are there other types? Can we do what's called a ROBS plan? Horrible acronym, but it's called Rollover for Business Startup. So that's essentially if a client has money in a 401k, can we use it as funding? Yes. Can we get business credit cards and do stacking? Sure. I mean, there's lots of other alternative arrangements, but my goal today was to help you understand how to categorize the three primary types of funding. And then also, I guess, to just validate, yes, funding does happen, but it happens with credible businesses. So with that said, okay, so Adam's asking about credibility. So I believe that it would be inaccurate to assume that any client can get business funding without being credible. So I guess that's the opposite of what I've been saying. It's in red. You need to be credible to get business funding. So that's true if we're going to Wells Fargo or Bank of America or Stearns Bank or the Chapman Fund or wherever else. So of course, because lenders are in the business of loaning money, whether they're a for-profit or a nonprofit lender, but they really want to be repaid because that allows them to loan that money again and continue the cycle of lending. So I need each of you to please come to the grasp that credible businesses get funded. Businesses that aren't credible probably won't or won't get as much. But any business can become credible. You and I can help any business become credible. We guarantee it. Because we know the formula, right? All right, so let's move on. Audrey's got the next question. If a client does both the credit and funding and the startup program, are they required to get funding under both agreements? No, no, no. So let's drill into that a little bit. I would say it's like two sides of the coin. So you have credibility of the business owner, and on the other side, you have the credibility of the business. If we're trying to get business funding, then we always need a credible business, right? That's why it's in red. That's why we've mentioned it several times. So for business funding, the business needs to be credible. Adam, a moment ago, was kind of asking the opposite. Well, does the business owner need to be credible? And the answer to that would be it depends on the loan program, to what extent that the underwriting looks at the individual owner in lieu of, or instead of, or in addition to the business itself. But getting to Audria's question, so you're right, you might have some clients, Audria, that start here, but then you realize that the business owner has some credibility constraints, and we might want to get them into the credit and funding program. That's the other side of the coin. So they don't have to do both, but that would not be uncommon. Because we split it into two. I had one person, it was a couple days ago, maybe it was even last week, said, well, why is this separate from credit and funding? Well, because not everyone needs help with a credible business. Some people have that, right? So if that's not a problem for them, they don't need a solution for it. So we break it into two sides of the coin. Do you need help with credibility of the business? Do you need help with credibility of the business owner? Can we get funding with one of the two? Yes. Is it better to be credible on both sides of the coin? Of course. All right. So yes, yeah, we'll have them fundable by going through the business startup program. That was Adam's question. So the answer to that is yes. John's asking, are we charging a performance fee for the startup? Well, we don't. I mean, if you look at our information, we do not have a performance fee on the business startup program. It's not there. But some of you, like Audria, some of you have said that you wanted to add that, and we can't keep you from it. So, John, if you want to edit your client agreement for the business startup program and add a performance fee, you can. We don't. We don't really have an opinion. It's up to you, right? That's a benefit of you being a branch, and it takes us back down to, down here. I mean, we'd like for all of you to be set up as a branch office, and by doing so, you control the client terms and conditions. So it's up to you, John, if you want to charge a performance fee for the startup package. By default, no, it does not have a performance fee. Sorry if I confused you there. All right, so Tina asks, if a client is enrolled in credit and funding and the startup program, will we help them get the Chapman Fund as one of the lenders? Absolutely. The Chapman Fund is a very, very important source of capital. Not really identified, broken out here, but the Chapman Fund typically falls into this category. And it's a great resource, and anyone that's in the business startup program geographically qualifies for it. So that's all good, Tina. But the problem is this: the Chapman Fund will only go up to $250,000. That's it. So if a client wants and needs more than $250,000, we have two options. Number one, they enroll multiple times, so we do multiple capital raises, so the cumulative effect is more. Or we use the Chapman Fund as one tranche, and then we have additional tranches that could be composed of any of these categories to raise more. Make sense? But yeah, the Chapman Fund is incredibly important, incredibly attractive, and kind of built in, if you will, to the business startup program. Great questions this morning. Sylvia asks, can the rollover 401k be used for the refundable setup fee? Well, that's a good point. So, and again, I know it's a horrible acronym, ROBS, stands for rollover for business startup, but it's credible, it's legal, it's not bad. They're not breaking the tax protection of their retirement account. And so they're not cashing it out, it's just repositioning it so it can be used as funding for their business. It's great. It does require, there's some requirements. So when you and I are going through the SBA Form 413, the PFS of clients, if we see that they might qualify for that, then we'll be discussing it with you. But with that being said, that is a resource once they're in the program. Sylvia's question is, could they use that to get into the program? Well, we don't know what they qualify for and what they don't until they enroll. We gather data and we start working the file, and we don't work the file until they're a client. So I guess the answer to your question is no, that wouldn't work on the front end, but it would certainly work as a potential source of capital. Vicus asked, are we planning an in-person weekend boot camp for the startup funding? There's been some discussion about that, but I think we've made it so simple, especially, and this goes to Brenda's point, we threw out there yesterday our offer to start doing daily business briefings, and maybe that's poor terminology, but what that would mean is each weekday at an agreed upon time, we would go through the value proposition of the business startup program. So you wouldn't have to, so you could have your prospects attend, and then afterwards you close your prospects. So you're still generating the leads, but we do have leads for if you need. We would do the pitch, if you would, step 2 of the sales funnel, and then step 3, you would still do the close, or if you didn't want to do the close, you could just treat them as a referral and we'll have someone else close them. So with that being said, I don't know that the startup program is complex enough that we need to get everyone to fly in. I think the training that's available, if you all plug into what's currently on the YouTube channel, should be adequate, plus the fact that it looks like we'll start those daily briefings, which is Brenda's question, which I made reference to. So far, everyone has spoken very positively about us having those, and so we're just waiting to hear back from the rest of you that have not responded, kind of take a tally, but yeah, I would assume that we'll start those before November 1st. If that doesn't make sense to anyone, go back and see yesterday's training. We talked about it. All right, John asked if he does charge a performance fee for the startup program, which is fine if you want, is that split 50-50? Yeah. And that's the beauty of our relationship, John, and other branches is, we both prosper together. So of the $2,500 that the client pays for the business startup program, frankly, we do all the work, but how much do you make? You make half. If you're going to charge a performance fee on our program, then that's fine. We'll split it 50-50. I think on Audria, not Andrea. We have an Andrea and an Audrey. I think Audrey is doing 4% performance fee. So she's making 2 points and we're making 2 points. Now, you might think that's not much, but figure out what's 2 points on about $20 million, right? It's a lot of money. It's about $20,000, right? A performance fee. So you can choose if you want to add a performance fee or not. That's between you and the client. Obviously, it needs to be part of your agreement so everyone's on the same page. But yes, we would split that 50-50. All right, Vicus asks, can we get a client 2 tranches of funding from Chapman at different intervals? Yes, but let's break that down. So Chapman is just one source of funding. It's a very valuable one, and of course, we've built the business startup program around the Chapman program because we meet the geographic qualifications for it. As I mentioned earlier, the Chapman has a hard cap at $250. So Vicus asked, could we go for multiple tranches from Chapman? Yes, but it's still not going to change the cap at $250. But there's so many other sources of capital that we don't need to become overly fixated on, well, I need $1 million and Chapman won't work. This sucks. No, let's get the first 250 through Chapman. There's many other sources of capital. The problem is not, and I've said this a couple times, maybe in a different context, there's not a problem with money. The money's out there. There are lenders that want to loan money, but who do they want to lend it to? They want to lend it to credible businesses, and that's what you and I do. All right, so one more question and we'll wrap it up because I'm running along, and I apologize. So Brenda asked, well, there might be a couple questions in her statement here. First question in her statement: what is the possibility of having a video for prospective clients for the business startup program? Yeah, and I guess we'll have that soon, right? So let's assume that we're going to start having those daily briefings, which we just talked about on yesterday's training, and then we'll record those. So once the first one is recorded, you would have it. Now, I guess she's asking about having them sooner, but I can certainly visit with our folks. Maybe we could start those daily briefings even sooner. So maybe you could have the first recording of one of those as soon as Monday. All right, so with that, we're going to hang it up for today. Hopefully this was a helpful discussion, very practical, right? Because any client that we're doing a capital raise for, we need to know, obviously, how much funding do they want? They can't just say, oh, I'll take as much as you can get me. No. How much funding are you looking for, and what do you plan to spend that money on? And it's going to be composed of one or more of these categories. So there's not like right or wrong answers or better or worse answers. It just needs to be the truth. How much do they need for each of these three categories? If they don't need any real estate financing, fine. It's not like some incentive to get them to buy real estate. How much do they need for equipment financing? If it's any, then we need to identify specifically the equipment, because as we said a couple times, typically the lenders are going to pay the sellers directly for equipment. And how much do we need for business loans, lines of credit? This is the one that we have to be really cognizant of. What collateral does the client have? And you and I know how much collateral they have by looking at their financial statements, their balance sheet, and their PFS. If they want more funding than they have collateral, not a problem. We can legally and ethically transfer assets over to them so they have the collateral needed. All right, well, thanks, everyone. Sorry to be long-winded. We'll see you back tomorrow morning. Let us know if we can help you. Bye-bye.